welcome. You're tuned in because you want that core knowledge, the
Mm,
real substance on important topics, minus all the fluff.
that's the idea.
So think of this as your direct line to understanding, well, a really critical part of the business world.
Hmm.
We're talking about how auditors communicate when they find, let's say, potential trouble brewing inside a company's systems.
Exactly. And specifically, we're zeroing in on what happens when auditors spot weaknesses in a company's internal controls, their
Yeah.
checks and balances.
Right.
And our guide for this deep dive is ISA 265. That's the International Standard on Auditing 265.
Okay.
Think of it as the kind of the rule book for auditors on how they need to flag these issues and who they need to tell.
Which is usually the people running the show and those overseeing them.
Precisely. Management and those charged with governance, the board, the audit committee.
Right. So our mission today, it's not really to get lost in all the technical jargon, is it?
No,
Yeah.
definitely not.
It's more about understanding the essentials. Like, what is an internal control deficiency, really?
Yeah.
What makes one serious enough that it needs, top-level attention?
And what do auditors have to do about it?
Exactly. And this isn't just like dry accounting theory. This touches on the fundamental health, the transparency of an organization.
It really does. It affects investors, employees, stakeholders, pretty much everyone involved.
Okay, so let's dive in. Where do we start? The basics. What counts as a deficiency?
Yeah, let's start there. What exactly is a deficiency in internal control? It's more than just a tiny slip-up, right?
That's correct. Basically, a deficiency exists if a control something that should be stopping or finding problems like misstatements isn't actually designed right.
Okay.
Or maybe it's designed okay, but it's not implemented properly, or people aren't operating it effectively, so it just doesn't work in practice.
Right. It's there, but it's not doing its job.
Exactly. Or, and this is the big one, it could just be that a control that should be there is completely missing. Ah, okay, like a necessary safety net that just wasn't put in place at all.
Precisely.
So we're not talking about, minor administrative hiccups here.
No.
We're talking about shortcomings that could genuinely allow significant errors or maybe even fraud to slip through the cracks.
And end up affecting the company's financial reports.
Exactly. The kind of stuff that can really snowball if it's not addressed.
Okay, so that's a deficiency in general. But you mentioned ISI 265 really focuses on significant deficiencies.
Yes.
So obviously, not every little thing an auditor notices triggers a major alarm.
Yeah.
What elevates it? What makes it significant?
Well, a significant deficiency is defined as a specific deficiency or sometimes a combination of a few deficiencies.
Ah, okay, they can add up?
They can.
Yep.
And in the auditor's professional judgment, it's important enough that it needs to be brought to the attention of those charged with governance.
So the board, the audit committee, basically the people at the top responsible for oversight. That's generally who we mean, yes.
Yeah.
The ones ultimately responsible for overseeing financial reporting and those internal controls.
So it boils down to, is this serious enough that the top brass needs to know about it?
Pretty much.
What kind of factors do auditors consider when they're making that judgment call?
Well, there are several key things. Two primary ones are, first, the likelihood.
Okay.
How probable is it that a misstatement could actually happen because of this deficiency?
Right. Is it a long shot or pretty likely?
Exactly. And second, the potential magnitude. If a misstatement did happen, how big could it be? Financially significant.
That makes sense. High likelihood plus high potential impact equals big problem.
Absolutely.
Yeah.
That's the core of it. But ISA 265 gives more detailed examples too.
Like what?
Well, the auditor might think about the overall chance of material misstatements cropping up in the financial statements generally,
All right.
or how much judgment and complexity is involved in certain accounting estimates,
Mm-hmm.
things like provisions or valuations. If controls around those are weak, the risk shoots up.
Right. If a company relies a lot on complex guesswork, and the controls around checking that guesswork are flimsy, that sounds like a potential significant issue.
Precisely. Other things they look at, the actual dollar amounts and the accounts that are exposed because of the deficiency.
The scale of what's at risk.
Yeah. And the sheer volume of transactions flowing through those areas. Also, how critical are these specific controls to the whole financial reporting process?
What do you mean by critical controls?
Things like general monitoring controls, controls designed specifically to prevent or detect fraud, controls over selecting accounting policies, or how they handle transactions with related parties.
Ah, okay. Weaknesses there could have ripple effects.
Exactly. It's like finding a crack in a really crucial part of the building's foundation.
Yeah.
They also consider the cause and how often exceptions are being detected because of the weakness.
So is it a one-off mistake or a recurring problem?
Right. And importantly, how does this deficiency interact with other deficiencies? Sometimes a few smaller issues combined can create a significant risk.
The whole is greater than the sum of its parts, potentially?
You could say that.
Okay, that paints a clearer picture of the judgment involved. Are there any specific, telltale signs, red flags that almost scream significant deficiency?
Yes, ISA 265 does list several indicators, things auditors should be particularly alert to.
Such as?
Well, one is finding evidence that the overall control environment is ineffective.
What does that mean, the control environment?
It's sort of the tone at the top, management's attitude, their commitment to integrity and ethical values, how they exercise oversight. If that foundation is shaky, it's a bad sign.
Got it. So if leadership doesn't seem to value strong controls, that's a red flag itself.
Definitely. Another indicator is finding signs that significant business risks aren't being properly identified or managed by the company.
They're flying blind on major risks.
Potentially, yes.
No.
Or not reacting appropriately.
Yeah.
Also, any evidence of actual management fraud is a huge indicator.
Well, yeah, that seems obvious.
It does. And also, if management has failed to fix significant deficiencies that were pointed out to them before,
They knew about it and didn't act.
that suggests a problem, yes. Or maybe there's just no proper risk assessment process in the first place.
Wow.
Or even if there is a process, but there's evidence it's just not working effectively. That's another warning sign.
That's quite a list already.
It is. The standard also highlights situations where the auditor finds deficiencies that the company's own internal controls should have caught but didn't.
So the company's safety nets failed, and the auditor found the issue instead.
Exactly. And maybe one of the clearest indicators, if the company has to actually restate previously issued financial statements because they found a material misstatement caused by error or fraud.
Oof. That's like a public admission that past numbers were significantly wrong.
It's a very strong signal that something fundamental wasn't working correctly in the controls.
You can't get much clearer than that, can you?
Not really. And finally, the standard points to any evidence suggesting management just isn't capable of properly overseeing the whole process of preparing the financial statements.
Like they don't have the expertise or the resources.
Could be either, or both. If they can't fulfill that core responsibility, it indicates a significant underlying weakness.
Okay, so auditors are actively looking for these serious issues. Let's say they find one or several. They identify a significant deficiency. What then? What's their responsibility according to ISA 265?
Right, this gets to the core of the standard communication. The auditor must first determine if they've actually identified any deficiencies during the audit.
Okay.
And if they conclude, yes, we've found one or more significant deficiencies, then they have an obligation. They must communicate these
To
two groups. Those charged with governance, again, the board or audit committee,
Right.
and also to management.
And the why behind this seems pretty straightforward, doesn't it?
It is. It's all about making sure the people who are actually in charge, the ones who can make changes.
Know about the problems.
Exactly. Know about the weaknesses so they can take steps to fix them. It's about providing them the info they need to understand the shortcomings and, hopefully, implement corrective actions.
To reduce the risk going forward.
Precisely. To lower the risk of material misstatements happening in the future.
So how does this communication actually work? Is it just a quick chat, an email, a formal report?
Well, the standard is quite specific here. For significant deficiencies, the communication absolutely must be in writing.
Okay, so no informal corridor chats about the really big stuff. It needs official documentation.
Correct. That ensures there's clarity, a formal record, avoids misunderstandings.
Makes sense. What else?
Second, this written communication has to be done on a timely basis.
Meaning, soon.
Yeah. Prompt communication is key. The people who need to act on these critical weaknesses shouldn't be finding out, months after the audit work is done. They need time to react.
Right. The sooner they know, the sooner they can start fixing things. So what actually goes into this written communication?
Again, ISA 265 lays it out. It needs to include a clear description of each significant deficiency they found.
Okay.
And crucially, an explanation of its potential effects. What could go wrong because of this weakness?
So not just Control X is weak, but Control X is weak. And this could lead to, say, overstated revenue or undetected theft.
Exactly that kind of explanation, providing context.
Okay. What else?
The communication also needs to give enough background information so that the board and management can understand the context of what they're being told.
Like,
It's like explaining the overall purpose of the financial statement audit itself. It's important to remind them the auditor's main goal was to give an opinion on the financial statements,
right.
not specifically to give an opinion on the overall effectiveness of the company's entire internal control system.
That's a really important distinction. So the auditor isn't saying your whole system is broken.
Yeah.
They're saying, look, while we were auditing your financials, these specific significant weaknesses in your controls caught our attention, and you need to know about them.
That's precisely the message. The written communication also needs to explicitly state that the deficiencies being reported are only those the auditor noticed during their specific audit procedures.
Ah, the scope limitation.
Yes. And critically, it should clarify that the audit wasn't actually designed to find all possible deficiencies in internal control. There might be others they didn't spot.
So they report what they find that's significant, but they're not guaranteeing they found everything. Because a financial audit isn't primarily an internal control audit.
Exactly right. Now that's for significant deficiencies, formal, written, to governance and management. But what about other less severe deficiencies?
Yeah, what if they find things that are problems, but maybe not quite rising to that significant level?
The auditor still has a responsibility there. They should communicate other internal control deficiencies that, while not significant, are still important enough to warrant management's attention.
Okay, so management still needs to know about those lesser issues.
Yes, if they're considered of sufficient importance. This communication to management can be oral or written.
Ah, so potentially less formal for these ones.
It can be, yes. But it also needs to be timely. Management needs to know about these relatively promptly, too, so they can decide what action, if any, to take.
So it sounds like a kind of two-tiered approach. The really serious stuff gets the formal written treatment, goes to the very top.
Right.
And the less critical but still noteworthy stuff gets flagged to the management team, maybe more informally, but still needs to happen promptly.
That's a good summary. The underlying principle is making sure that any identified weakness impacting financial reporting gets to the right level of responsibility so it can be addressed.
Does the standard say anything about how the size or complexity of the company affects this?
It does touch on that briefly. For smaller companies, especially where the owners are also the managers,
Owner-managed businesses.
right, the communication lines are often much shorter, more direct. So the way deficiencies are communicated might feel less formal.
Maybe just a direct conversation.
Could be. But the substance remains critical. The auditor still needs to make sure that owner-manager fully understands the issues found and what the potential consequences are.
So even if the delivery is less formal, the message has to be just as clear about the significance.
Absolutely. And the standard also makes a special note about public sector entities.
Government bodies, state-owned enterprises.
Yes. In that world, there might be extra or very specific requirements for communicating deficiencies. These could come from laws, regulations, or specific mandates from government oversight bodies.
So auditors in the public sector need to be aware of those additional layers.
Definitely. Public accountability often brings more stringent reporting rules.
Makes sense. Okay, let's circle back quickly to timing. You stressed timely communication a couple of times. Is there a hard deadline?
The standard emphasizes making the communication, especially for significant deficiencies, as soon as practicable. Really, the goal is to allow management and governance to take prompt action.
Get ahead of the problem.
Right. Now, ISA 265 doesn't set, like, a specific number of days as the universal deadline, but the general expectation, the guideline, is that the final written communication of significant deficiencies shouldn't be issued any later than the date of the auditor's report on the financial statements themselves.
Okay. So generally, the news about significant control weaknesses comes out around the same time as the auditor's overall opinion on the company's financial health for the year.
That's typically how it works, yes.
Wow.
It ensures all the key results from the audit, including any major control issues found, are presented to the right people together in a timely package.
Okay, I think that brings it all together nicely. So, recapping our deep dive into ISA 265, auditors, as part of their job, are actively looking for weak spots in a company's internal controls.
That's right.
When they find weaknesses that are significant, meaning they have a real potential to cause material problems in the financial statements, they have a clear professional duty. They have to communicate these findings in writing to the highest levels, the board or audit committee, and also tell management.
And this whole process isn't just bureaucratic box ticking. It's fundamentally designed to ensure those in charge are aware of the risks.
So they can actually do something about them, fix the problem.
Exactly. And hopefully, for everyone listening, you now have a much clearer, more solid grasp of this really crucial piece of financial oversight.
Yeah, it's not some obscure rule buried in accounting manuals. It's fundamental to making sure financial information is reliable and transparent.
Which is the bedrock for so many decisions in the business world.
Absolutely. So maybe a final thought for everyone to chew on as we wrap up. Just consider the flip side.
Okay.
What happens if a company doesn't have strong internal controls? Or if significant weaknesses are found but maybe not communicated effectively or just ignored?
Right.
What kind of hidden dangers, what potential for errors, or worse, intentional wrongdoing does that create? And what's the potential ripple effect on the company, its investors, its employees, maybe even the wider economy?
It definitely makes you think about how interconnected and important this seemingly technical area really is.
It really does. Well, thanks for joining us on this deep dive today.